Corporate finance practice problem using OneNote. Rights offering, rights valuation calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab down in the 1722 Rights Offering, Rights Valuation Calculation. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will be down in the text area as well with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read with them. Closing the icon, we have the information up top, calculations then on down below. We're looking at a rights offering and the calculations of valuation related to them. When you're thinking about a rights offering, the general scenario you want to be keeping in mind is corporation trying to generate capital, trying to generate cash. They would like to do so by issuing stocks directly from the corporation in return for the cash. However, stocks are already out there, so they would like to then give a benefit to the current shareholders, possibly to purchase at a discounted price. That way, it could give them the advantage to be able to take advantage of the discounted price and possibly not have the stock be diluted for them in their holdings. So there's a concern, of course, when more stocks is going to be issued, what is going to be the impact on the current stockholders that currently own the stock. And that's going to be one of the issues, one of the themes as we go through some of these practice problems. That's the general type of scenario. So here we're going to say that we have the subscription price is 91. Now the subscription price means that when the corporation basically issues the rights, they're going to say we're going to have rights that are going to be issued. They're going to give some portion of those rights to the shareholders, possibly one right per shareholder is going to be the general assumption that we're going to make, meaning one right per share. Then they could basically purchase another stock of the new issuance at a discounted price. We're going to call that discounted price the subscription price. In order to take advantage of that, they're going to need the rights as well with the cash at the subscription price. The rights needed with the subscription price to buy one new share is going to be 7. So the general idea here then is we're thinking that they're going to be issuing a right to the existing shareholders, 1 per share, and then they're going to be basically needing 7 of those rights in order to buy a new share that's going to be issued at the discounted price, the subscription price of the $91. The price before this took place, the stock selling for rights on price is $105. So now let's think about some valuation type of calculations. And notice this will kind of change in terms of when the timing is as with regards to what is going to be taking place here. So obviously this is going to take place over a time frame. They're going to want to generate the capital. They're going to want to have then the rights offering that are going to be taking place. And of course, that's going to the offer is going to end at some point in time in the future. So we're talking about the offering point at this point. We got the right value. It's going to be the come rights period is going to be equivalent to this calculation. We got the stock price. This is going to be the value of the right itself, that we're trying to estimate the value of the right itself. That's going to be the stock price minus the rights subscription price per share divided by the number of rights required to buy one share plus 1. So let's see the calculation. It looks like this. We're going to say that the value of one right is going to be the stock selling for rights on. That's going to be the 105, basically the market price. You could think of it pretty much before, this took place. Then the subscription price is going to be the 91. That's the lower price that could be purchased if they take advantage of the rights offer, and they would need 7 rights in order to do so. The 105 minus the 91 gives the 14 being the difference there. That's going to be our numerator. On the denominator, we're going to take the rights needed for one share, which is going to be 7. Then we're simply going to add 1 to it, as our formula says up top. That's going to give us 8. So we got 14 and 8, and that's going to give us the 1.75, or in other words, we've got the 14 divided by the 8, or the $1.75. Scrolling down then, the next thing we can take a look at is the X right price. So this is us thinking about, well, what's going to be the price then of the shares if it's going to be after the rights. So in other words, we had before the selling price of the 105, and now we're saying that basically we could think about this as having 2 components to it now. We have a rights to it, which we could think of as having its own value, and then we can think of the value of the stock portion itself. So the simplest way we can consider the X right price at this point would be the stock selling for rights on, the 105, that's the starting point, and then we have the value of one right, the 1.75, and you get the one right per share. So that would give us the, if you subtract that out, that's going to give us the X right price, which you can estimate basically, that's kind of like an estimate of what the price of the stock will be after this whole thing has basically taken place. It's going to be a little bit less after the rights issuance has taken place. And you can think about that in another way. You can think basically, well, what's going to happen, and we'll talk about this a little bit more in future problems, but you could see basically the cost of the stock, the market price is going to go down. You could think of that in basically aggregate by thinking about what does the market think the value of the company is. The value of the company is going to be the market price basically times the number of shares that are out there. And then if you think about the company issuing new shares at a price, $91, if they take advantage of the rights, which is less than the market price, the company is going to be taking in cash, and that's going to be increasing the value of the company because they're getting cash. But the cash they're taking in is not going to be equivalent to the market value of the shares before they issued the shares. Therefore, you would think that the end result, what would happen to the shares themselves, is they would go down. They would be slightly decreased after the stocks rights issuing has taken place, because now you're going to have more shares that have been issued out there at a price, which is going to dilute the total pool that's going to be out there. And they were issued at a price less than the market price, so they got less cash than they got for basically what would have been the value of the shares that they issued. And so you can then think that the price after the rights offering has run its course would be less than, all else equal, to the current price before that took place.